Hey everyone, it's Julie here with TipRanks, and today we're taking a look at 3 trending tech stocks that have been dipping in price lately. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at trending stocks, specifically the best rated stocks in the last 30 days. And near the top of that list, we have 3 tech stocks all rated a strong buy, but have been dipping in price in the last few months. So we're going to take a look at these companies, what it is that they do, and why analysts think it might be time to buy the dip. Just before we get into that, this is a friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can also download the TipRanks mobile app on your Apple or Android device by following the links in the description down below or scanning the QR code on your screen. Now to find today's stocks, we went to TipRanks trending stocks page. This is found right at the top of the research tools menu, and under here we looked for the best rated within the last 30 days and got our list down below. First up today is MongoDB. They trade under the ticker MDB, currently priced at over $251 per share. Over the last 6 months, they are down 3%, but from this high back here in December, the stock has actually dropped over 26%. MongoDB is an open source database system that stores and processes large amounts of data. They serve environments where the data model is dynamic and where scale and performance are critical, making it suitable for content management, mobile apps, IoT, real-time analytics, and more. They store their data in documents, use a document-oriented data model, process structured, semi-structured, and unstructured data, and support a variety of queries. They also have cloud services with their MongoDB Atlas, which is a fully managed cloud database service offering automated backups, scaling, and security features. They shared their Q3 earnings report on December 9th, and as you may recall from their stock chart, that is when the stock really dropped off, so you might think it didn't go well, but the company did have a big earnings and revenue beat. They did announce the retirement of their CFO during the quarter though. For their third quarter, they reported earnings per share of $1.16, beating analyst estimates by 47 cents. Revenue grew 22% year over year, coming in at $529.3 million, beating by over $33 million. And they continued to see strong customer growth with over 52,600 customers. Other highlights included their Atlas revenue growing 26% year over year and the successful launch of their MongoDB 8.0, as well as other AI application program expansions. Just today, an analyst from Guggenheim upgraded their rating on the MongoDB stock to a buy. They said that the company seems more like the ugly duckling in infrastructure software as of late than the soaring eagle it's long been, with their shares being down 30% since that Q3 earnings report. However, the firm's most recent channel check indicates that Q4 consumption accelerated from the last quarter, and assuming stable consumption in fiscal 2026, they see Atlas accelerating to 29% growth. On top of that, Wedbush also recently named them in their list of top 10 tech winners for the AI revolution into 2025. With 27 current analyst ratings, MongoDB does come in as a strong buy based on 23 buy ratings, 3 holds, and 1 sell. And the average price target of $381 implies an upside potential of 51.5%. Looking at those recent price targets down below, our low-end price target, of course, is that sell rating at 220, which would be a downside of over 12%, while we have multiple targets on our high end at 430 for an upside of over 70%. The second stock on our list today is Micron. They trade under the ticker MU, currently priced at $99.54. They've dropped over 23% in the last 6 months and are fairly flat in the last 3 months, down 3%. Micron is a semiconductor company that develops and manufactures memory and storage solutions for a variety of industries. Founded back in 1978 in Idaho, Micron is the only US-based manufacturer of memory. Their solutions are used in computers, smartphones, the automotive industry, consumer electronics, data centers, and AI applications. Micron shared their Q1 earnings report on December 18th, and once again you'll notice a big decline in the stock associated with this date. They did come out with an earnings and revenue beat, but their future outlook fell short of expectations. For their first quarter, they reported earnings per share of $1.79, beating estimates by 3 cents per share. And they also had record Q1 revenue driven by strong AI demand of $8.71 billion, which was in line with expectations. Their data center revenue grew 40% sequentially and over 400% year over year. Along with that data center growth, they also had a strong position in enterprise and data SSD, increasing their market share there, and also announced several industry-leading products. Some of the lowlights were their NAND market challenges, where they say conditions remain challenging, and some pressure on their gross margin. And recently reiterating a buy rating on the stock was an analyst from DBS, saying that the company is well positioned to benefit from the increasing demand for AI-driven memory and storage solutions, which is expected to see robust growth in the next decade. The digital transformation in data centers is a significant growth driver, with expectations of rapid compound annual growth rates in both the DRAM and NAND applications. And despite a slight miss on earnings guidance, the overall outlook remains positive, supporting their buy rating. With 22 current analyst ratings, Micron comes in as a strong buy with 20 buy ratings and 2 holds. And the average price target is $136, implying an upside potential of 37%. Looking at those ratings down below, our low-end price target is a hold here at $98 for a slight downside just over 1.5%, while our high-end price target comes in at $250 for an upside of 150%. If you've made it all the way to our third stock today, then this is a reminder to make sure you hit that thumbs up button. Last but not least, we're looking at Uber Technologies. They trade under the ticker UBER, currently priced above $66 per share. The stock has fallen 7% in the last 6 months, and in the last 3 months is down 11%. Uber, of course, is known as the tech-driven ride-sharing platform. Along with their well-known ride-hailing services, they also offer Uber Eats, Uber Freight, Uber for Business, and Uber Travel, among others. They leverage technology to offer these services, including GPS for routing, real-time pricing based on demand, and payment systems all within the app. They're also working on self-driving cars through a partnership with Waymo and Cruise. They're expanding partnerships to bring autonomous ride-hailing to different cities starting in early 2025. Uber shared their latest earnings report back on October 31st. Now, they didn't have quite as sharp as a drop-off as the other stocks, but it has been steadily declining since. We did see a bump up today after they announced a $1.5 billion accelerated share repurchase program. But for that earnings report, they did come out with an earnings and revenue beat, but did have some cautious future outlook. For their Q3, they reported earnings per share of $1.20, which was a big beat, exceeding expectations by 82 cents per share. Revenue grew 20% year over year to $11.2 billion, beating expectations by $220 million, and this was another record quarter of profitable growth at a global scale. Their gross bookings grew 16% year over year, and they had free cash flow of $2.1 billion. And just today, Uber was added to the best ideas list over at Wedbush, saying that the risk versus reward for Uber has become more attractive, with shares trading for only 12.9 times their 2026 adjusted EBITDA estimates, reflecting terminal risk related to AVs or autonomous vehicles. The firm views the dislocation as unwarranted for a company demonstrating strong fundamentals, with top-line growth in the mid-teens and adjusted EBITDA set to grow over 30% year over year in the next 2 years. While the long-term evolution of the AV industry is admittedly uncertain, Wedbush believes the company will likely have a role to play as a partner to leading AV technology providers. The stock has attracted 35 current analyst ratings, coming in as a strong buy with 33 buys and just 2 holds. And the average price target of $93 would imply an upside potential of 41% from current prices. Looking at those ratings down below, our low-end price target is $82, which would be an upside potential of over 23%, while our high-end price target comes in at $100 here for an upside of over 50%. So that is a quick look at 3 strong buy tech stocks, all trending with Wall Street analysts lately after trading a bit in the red in recent months. Let me know your thoughts on these companies in the comments down below and which one catches your eye the most. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you stick to your own investment plan and always do your own research and due diligence. Thank you guys so much for watching. I hope you have a great Monday, and I'll see you back here next time.